from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
Chang in New York, and this is Bloomberg Technology. Coming up in the next hour, Hollywood breathes a sigh of relief. Netflix is growing again. Expectations were low after the streaming giant lost subscribers last quarter and suddenly pivoted to ads. What's working? We'll discuss. Plus, women are leaving the top ranks of companies at higher rates than ever before, according to a new report from McKinsey and Lean In. What they're calling the great breakup later this hour. And why has Zuck been so quiet about Facebook these days? The Meta CEO seems to be ignoring his flagship social network to focus on luring people into a vacant virtual world. We're going to get to all of that in a moment, but first I want to get a look at the markets. Tech stocks climbing for a second day as we head into a key earnings season. Bloomberg's Ed Ludlow here with the biggest moves. Ed.
Yeah, a back-to-back game for the NASDAQ 100, but it's the first back-to-back game for tech stocks in around 2 weeks. And as you say, we've come into this with a pretty high level of anxiety looking ahead to earnings season. Broadly, tech underperformed the broader S&P 500 while yields creeped higher. A story that we want to get to straight away is that of Apple. Really interesting. The information reporting, according to people familiar with the matter, that Apple has cut production of the iPhone 14, which certainly impacted Apple shares. But remember, Apple accounts from a weighting perspective for 7% of the S&P 500. So it had a real sort of jittery effect in markets. Saw the S&P 500 pare some of its losses. But you can see on the screen there, pretty sharp drop, pretty big knee jerk. I know Bloomberg's reported as well some of the difficulty Apple has had in managing its suppliers when it comes to the level of production for the iPhone 14. We are in the thick of earnings season, Em. Here it is. Get ready. Netflix reporting almost double what it expected in terms of subscriber growth in the third quarter. You see those shares now higher, 14% in after hours this Tuesday. Other names in the world of streaming, Disney, Roku, also pushing higher. I know you're going to get into Lucas right now about your favorite show. Mine was the TV series remake of Resident Evil. Make of that what you will. But I think what is also interesting here is Netflix saying that after the current quarter, fourth quarter, it's no longer going to guide us forward or forecast subscriber growth. So like Apple does with its iPhone units, there's going to be an element of guessing game here. Maybe they learn from their mistakes of either being too positive or too conservative in what they've said before.
Ed, you really put me on the spot. I'm thinking Bridgerton, but that came out so long ago. They need a new one. They need a new one. Okay. And thank you for more on Netflix. I want to bring in Bloomberg's Lucas Shaw. Okay, Lucas, what are the good things you're seeing in this report? Why are we seeing a turnaround before a lot of these new changes have even been put into effect?
Well, it's growing again. So it added 2.4 million subscribers in the most recent quarter. That's way above what they forecast, way above what Wall Street forecasts. They also estimated 4.5 million additions in the fourth quarter. So Netflix is still going to have its worst year in a really long time. But people had been jittery because it had shrunk for 2 quarters in a row. The fact that it's growing again is seen as a positive sign. The fact that it has all these hit shows that came out in the most recent quarter, also a positive sign. If you wanted to be a bit of a pessimist, you could say, why did they only add 2.4 million when it had all those hits? And that's a legitimate question. But I think there was, the response to its slowdown had been so dramatic that a lot of people are just breathing a sigh of relief that it seems to be back on a more stable trajectory.
Now, what do we know about the ad-supported tier, and how is that impacting your outlook on how much better we can get here?
Well, it's going to release the new tier or start selling it in November. It'll cost $7 a month. You'll watch about 4 or 5 minutes of commercials per hour. Most of the programs that people watch or care about will be available, but not all. You won't have ads in new movies. You won't have ads in kids programming, although you may have sort of a pre-roll ad, just not ads in the middle of it. And so that means that Netflix's ad tier is cheaper than HBO Max's ad tier, cheaper than Disney Plus's forthcoming ad tier, a little more expensive than some of the smaller rivals. I think people are pretty optimistic that this should boost the company's performance in the years ahead, at the very least give people a reason not to cancel. But Netflix is saying it doesn't expect to see any material impact on its business in the fourth quarter, more likely in the coming year. It could, of course, just be trying to manage expectations.
What about when it comes to the content strategy? I mentioned Bridgerton is my favorite show, but It's been a while, and they talked about Monster, the Jeffrey Dahmer story. What are you seeing as kind of the next generation of big Netflix hits?
Well, I think there's the perception and then there's the reality, right? There's a perception in the marketplace right now that programming on Netflix has gotten a lot worse, that they're funding lots of bad shows, bad movies, and that people have moved on to HBO Max, to Apple TV Plus, to Disney Plus. And while I think there's some truth to that, and even Netflix has said that perhaps it's making too much, for the most part, Netflix is still making a lot of shows that people want to watch. It had movies in The Gray Man and Purple Hearts that people watched. It had Dahmer, which was one of its biggest hits. It had the new season of Stranger Things. It had this Korean show, Extraordinary Attorney Woo, that was hugely popular. So I think you'll see a lot more of that. Netflix just making a wide range of shows that appeal to people on the coast, to people in the middle of the country, people all over the world. And we'll see over time if they're doing enough to get people to come in. I think there's also a lot of concern about how much Netflix is spending on marketing, and the company is just starting to adjust its approach there.
So what are folks saying in Hollywood? Obviously, Netflix isn't doing all of this in a vacuum. You've got all of the competitors out there making their changes as well.
Well, I think people are, on the one hand, relieved because Netflix's problems had impacted the stock price and the strategy for a lot of its competitors. So even though they are rivals to one another, nobody wants to see Netflix collapse because every other company has basically bet their future on streaming. At the same time, you do hear a lot of sort of the whispers and snickers about the quality of programming on Netflix and how it's not as good as it used to be and not as fun as it used to be. Like I said, I think there's some truth to that, but some of that is also just a little bit of kind of lack of understanding of what people are actually watching. But we'll also see in the next few weeks what the results are like from Warner Brothers Discovery with HBO Max, from Disney with Disney Plus. Unfortunately, we don't really get numbers for Apple TV and Amazon broken out. But the positive results for Netflix should be a sign that if you can program well, there's still plenty of growth to be had in streaming.
So look, obviously, we're in the middle of a major macroeconomic downturn. You have consumers reevaluating their priorities. How many subscriptions do we really want to have? There's been a big reset in the content business. Where do you think this stands, let's say, a year from now? How does this all shake out?
Well, the big question is at what point some of these players decide that they'd be better off consolidating, right? You talked about people being more sensitive with how much they're spending. I think even the most optimistic person would say that people don't want to have to pay for more than 4 or 5 streaming services, and there are a number of services going for that mass scale. So does that mean that a Paramount Plus, Warner Brothers Discovery with HBO Max, a Peacock from NBC Universal, do some of those companies consolidate in some way? We've already seen Disney and Fox come together. We've already seen Viacom and CBS come together. There's been a lot of speculation that at some point there will be bigger deals. We just don't know when.
All right, Lucas Shaw, thank you as always for your analysis and insights here. Appreciate it. Coming up, not a lot of IPOs lately, but some updates on potential public offerings from Mobileye and Instacart amidst massive valuation cuts. We'll tell you more next. This is Bloomberg. Intel, self-driving technology company Mobileye, is targeting a valuation far below previous expectations for its IPO. Intel had recently lowered its expected valuation of Mobileye from $50 billion to $30 billion due to turbulent market conditions. Now that's closer to $16 billion. Here to discuss, our Bloomberg Deals reporter, Crystal Z. So clearly the market conditions not helping here, but what's behind this another valuation cut?
Yeah, so basically IPO takes a long time to prepare. They probably came up with the idea of listing this unit, Mobileye, when market was still booming. And right now it's went from 50 to 16. And 16, I would like to say it's not probably the final valuation. They launched with a range.
Do you think it could go lower?
It could go higher. It could go lower. If we're optimistic, we think it could go higher. But it's not the final valuation. And we will know next week when they actually do price the deal.
And are you expecting them to go ahead with this? I mean, is there any kind of cold feet on the other side? Like, maybe we shouldn't do this right now.
So if the market on the pricing day falls on a day like today where things are doing okay, like they could well go ahead, but everything is market dependent. It could just price on a day where everything is in the red and it would just be a total disaster, and we shall see. But right now, I think they have the intention to go ahead with this listing.
And what is the exact timeline?
We should expect a listing next week, perhaps middle of the week.
There's this question of, the unprofitable IPO and whether that era is coming to an end. And obviously, you've covered so many IPOs in boom times, and now you're covering the lack thereof. How are companies thinking about strategy in terms of what they want to get out of a public offering?
Yeah, so anyone who has raised money in the past year when valuation was still good, when money was still available, will unlikely be looking at an IPO. I think the mentality very much right now is that if you don't have to do it, don't do it. And I'm sure that's what the bankers are advising their clients as well. But if you're a company like Mobileye, where you have a parent company that is looking to return some money, then you would go ahead with this listing. But for people who have a choice, they will most likely not. So that also give it an interesting power dynamic. If you're an investor and you know that this company needs to go public, you have more pricing power.
So how long does the drought last, in your view?
Well, a lot of bankers are saying that we should expect the rest of the year to be quiet, or even the first quarter of 2023. So we will likely see some deals coming back meaningfully in the second quarter of 23. And it would most likely start with companies that are potentially revenue positive or even profitable. The things that we have covered in the last year where they have no revenue, they have no profit, those will have to wait.
All right, Crystal C. We'll keep checking back in with you and see if the timeline changes. Thank you. I want to move on to another IPO that's been highly anticipated. That is Instacart. Let's bring in Adam Birnbaum to discuss. He's the executive director at GP Bullhound, a tech advisory and investment firm with $1 billion under management. So Instacart, Adam, another one that's had massive valuation cuts. I believe it was valued at $39 billion at the height of its popularity in the middle of the pandemic. Now we're down to $13 billion. What's your expectation with this one?
I think, Instacart's in an interesting position because they don't really need the money right now. They've done a few things that are very, very astute. One, they raised capital at a higher valuation. Secondarily, they got their business model such that they became cash flow positive. And number three is they've evolved their business model so that they have alternative sources for it. So they have an advertising model, which is doing extremely well. All that adds up to they don't need to do a offering right now. The reason for doing an offering would just be to get some liquidity to a 10-year-old company for some of their employees. But I don't think they need to force to do it. I think there's another dynamic though that's out there, Emily, that's as interesting. And this is this legislation that's floating around Washington right now, which is the reclassification of gig workers. That's something that would have a material impact on their cost structure for these shoppers going from being independent contractors to being treated as employees. That I think the company is certainly up for it. It's a very well-managed company. Fiji is doing a great job. And so did Apuva, and this is a company that went from 200,000 shoppers to 500,000 shoppers during the height of the pandemic. This is a well-managed business, but all that's being said is that there's no need right now for them to have to do an IPO in a very, very auspicious market environment.
So are you saying that you think if they have to classify these workers as employees, it's not going to dramatically negatively impact the company, that they're prepared for it?
What I'm saying is that I think that they would be able to handle it because it's going to certainly impact the valuation models that institutions are looking at. For sure. And I think that in and of itself is a reason you hold off on rushing into an IPO market when you don't need to do it. This is a consumer-facing business. The aura of an IPO is important, and there's no reason to rush into a market. When you're in an environment like we're in right now, where there's so much red on the screens of institutional investors from past IPOs, you really need to pull off a transaction successfully. What you really need to do is you have to have everything aligned. So you don't need this other variable right now out there, which is impacting their cost structure. So I guess what I'm saying is they don't need to do it right now. I think they're up for the task if that's where the legislation happens. But that's far from a fait accompli right now.
Well, just talked to Crystal about the era of the unprofitable IPO, which was hugely popular, especially among technology companies. Instacart saying it's turned the corner on profitability. So I imagine that might be one less thing for investors to worry about. You know, is the era for unprofitable IPOs, is that over?
I think I wouldn't say you never say never, so I wouldn't say it's over forever, but I'd definitely say it's over for the short term. I'd say that, you know, there's a focus, and we're seeing this in our business across the board. We do a lot of M&A transactions. We're doing a lot of capital raising. We just raised $500 million for a business. There's a big focus on more mature models that have provided a pathway to profitability or demonstrating that their models are evolved. The days of companies going out with a somewhat of a pipe dream into the public markets, which frankly they shouldn't have been in the public markets to begin with. I think that, at least for the near term, we're not going to see that for a while.
So how are you changing your strategy, and what are you telling your clients amidst these evolving conditions?
Well, I think what we're telling people is, one, the M&A market continues to be open, particularly from very, very good areas. Things like cybersecurity, ESG. We do a lot of work with digital analytic businesses and digital transformation companies. These are companies that have core organic growth within their addressable markets, which are going to continue. What we are telling people is that for those who are considering the IPO market right now in this environment, that is not something that we would strongly recommend, for sure. It's definitely not something that needs to be done. I think that there are, in between all this negative discussion, is that still this year we're going to have a record amount of capital coming into venture funds. It's just going to be more concentrated. And I just think there's a flight, it's just a general flight to quality. So that's what we're advising people, that don't rush ahead to do something unnecessarily, but there's certainly a market and there's certainly transactions to be done, and transactions to be done at very, very fair valuations for companies that have more mature business models and have the economics to support it.
How long do you think the downturn will last? We're hearing, 6 months for the IPO window to reopen. I'm hearing from some other more skeptical folks, 2 to 3 years before we're out of this.
Yeah, it's a great question. When you look at what has happened over a period of time, right now, all these valuation models that institutional buyers look at are predicated on an interest rate. When you don't know what that interest rate is going to be, it's very, very hard to build the models accordingly. So it becomes very, very challenging when you have a Fed that is focused on breaking the back of inflation. And that's certainly the right thing for them to be doing, but it's hard to do that. I think that once you get to a stalled period of time in interest rate raises, and you start to see that we're entering into, and you start seeing the labor statistics supporting that, I think you're going to see a market that's going to be more receptive. And when markets start opening to the IPO market, the companies that go out in those environments have to be primo. They have to be the best companies in their environment. And that's really what's traditionally happens in any sort of bad IPO market. The market comes back because the best of the best go out there. They work. The institutions start feeling a little bit more comfortable, and then you start seeing additional companies come out. I would say, to answer your question, I'm thinking mid-time next year. I would say, Q4, no. Q1 still feels a little early. I would say maybe Q2, Q3, you start seeing it. And again, the equity capital markets are an environment that's, front runner. So we're going to be out in front of the economy.
You are on the more optimistic side than Adam Birnbaum, GP Bullhound. Thank you. Good to hear your perspective.
Thank you.
Coming up, Apple drops after a report about iPhone production, plus the company unveils new iPads for the first time in 5 years. We're going to talk about how the pandemic has changed the company's approach to tablets. This is Bloomberg. Apple just launched its first fully redesigned entry-level iPad in 5 years, but shares dropped on a report the company will cut production of the iPhone 14 Plus. Let's bring in Bloomberg's Mark Gurman to discuss. Mark, this report coming from The Information. What's your assessment about these production cuts?
I'm not sure what else Apple or investors or analysts should really expect when the phone comes out 3 weeks later than the other variations. It's basically last year's phone, but a little bit bigger, really no changes. And it's only $8 per month less than the iPhone 14 Pro Max. There's really not a good reason to buy that $900 iPhone 14 Plus when, again, on installments, a much better phone, the one you're showing on screen right now, it's only $8 per month. So if you're already spending $900 on a phone, chances are you can spend $1,100, especially if you break up that difference over 24 or 30 months.
Interesting. You've also got some new reporting on the iPads, new iPads. Tell us how big a change you're seeing here and why the change in strategy from Apple.
So 2 new iPads. One is the new iPad Pro with the M2 chip. The second is a new entry-level iPad. I'll start with the iPad Pro. That'll be a lot quicker. Smallest update in the history of the iPad Pro. The first one came out 7 years ago in 2015. They've essentially added just that faster processor. It's about 15% faster. I don't think you're going to see major day-to-day gains from last year's model. There's a new Apple Pencil hover feature you're showing, which now if you take the stylus over the screen, it can sense 12 millimeters away that you're there, so you don't actually have to touch the screen. It's kind of a cool but more of a software-based tweak. Now the entry-level iPad, I have no idea why anyone would buy the iPad Air. The iPad Air with the M1 chip, $600. This iPad entry-level has the A14 chip, so a little bit slower, but for over $100 less expensive. So I think it's going to be an incredibly hot seller. I think it's going to do well. The question is, what is Apple thinking right now with its iPad strategy? It's really all over the place. You have 5 or 6 distinct models. You have a lot of overlap in both pricing and functionality and capacities and design and colors. The software story is not in good shape. People have been asking for major multitasking improvements for years now. I don't think Stage Manager, which they're launching with iPadOS 16 and these new iPads next week, is the answer. I think they will do well the holiday season, particularly with the new colorful entry-level iPad. But I think they need to give the iPad Pro some serious juice, both in terms of hardware and software, and really define what the vision and the future of the iPad is. I think it's going to be bigger screens and Mac-like multitasking. But we'll see what they have up their sleeves in 23 and 24.
Mark, you never sugarcoat anything. That's why we love you. Thank you for giving it to us straight. Bloomberg's Mark Gurman, as always. Coming up, from the Great Resignation to the Great Breakup. Why women across corporate America are leaving in droves. That's next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in New York. I want to get to one of our top tech stories today. Twitter shares jumping after a Bloomberg scoop that the company has frozen stock accounts for its employees. This as the deadline to seal a deal with Elon Musk approaches. Bloomberg's Ed Ludlow helped break that story. So what happened?
So this is the Equity Award Center. It's a Schwab page where employees can go and look at the status of their restricted stock units, the value, and also what the trading dates are. And the company essentially, in the employee FAQs, said they'd frozen it. And the reasoning was that it's pending the acquisition of Elon Musk. It's basically a status update. You know, it's part of them saying that there are shareholders of Twitter stock as a public company. Some of them are employees, and for the time being, you cannot look at or trade those shares. Now, I think it's important to note that we're in a quiet period window anyway, where staff are prohibited from trading, but the timing's kind of got the market paying attention to what is largely a procedural development.
Well, and how does staff feel about this? I mean, they're already struggling with a brain drain.
Yeah, I mean, we know that, sources have told us staff had a number of them with restricted stock units due to vest on November 1st. They were holding off deciding on their own futures, should they leave the company or not until then, because, hey, stock's a big part of compensation. You also saw the market jump on this, right?
Why did the stock jump?
Well, I think a big part of it is that it's gone a bit quiet in what is an awkward situation where a Delaware judge has said you have until 5 p.m. on October 28th to work this out. Go away and do it between the two of you. It's a sign, an incremental sign, that they're moving towards this deal closing. It's a formality, but it's a positive sign to the market.
All right. Expect you to keep us posted.
I'll try.
Ed, thank you. Now I want to turn to what has been dubbed the Great Breakup, which is the phenomenon of women leaders leaving their companies at higher rates than ever before, and the gap between women and men leaders quitting. That's the largest it has ever been. This is according to the 2022 Women in the Workplace study by McKinsey and leanin.org. I want to talk about why we're seeing all of this with McKinsey senior partner Lorena Yee and leanin.org co-founder and CEO Rachel Thomas. Lorena and Rachel, I'm always looking forward to this report every year, mostly for a progress update, but this one is not so good. Rachel, explain what you mean by the Great Breakup.
Well, it's exactly what you said. For the first time that we've been tracking, women leaders, they're highly ambitious. They're as ambitious as men, but they're leaving their company at the highest rate we've ever seen and at higher rates than men. And we already know women are underrepresented in leadership, so companies cannot afford to lose their precious few women leaders. And to put the scale of this in the perspective for you, Emily, for every woman director who gets promoted, 2 women directors are choosing to leave their company. That's 1 up and 2 out, and that's a problem.
Lorena, you've been working in corporate America for so long. Why is this happening?
Well, we see some very persistent headwinds, none of which are going to surprise you. And we see a change in the mindset of women. So some of those headwinds, Emily, we've seen lots of different stabs and cuts every day, but we saw that clearly about 40% of women leaders said that someone took credit for their idea in their meetings this year. We saw that they were 2 times more likely than men to be mistaken for someone junior, actually kind of undercutting their leadership. And the list goes on. And these are the day-to-day headwinds. They're also not getting credit for being great people leaders. And so what we see is that when women give more, when they make sure that work works remotely and flexibly, when they actually take care of wellness, when they pay attention to D&I, they rarely receive credit. So those are some of the headwinds, which are signals to women, you're not going to advance. And the other thing that I mentioned is women's mindsets are shifting. They're saying, look, I am positively ambitious. I would like to get promoted. I would like another opportunity. And if that means I need to break up with you and go to another company, go to a competitor, go to a smaller company to get that promotion, to get that raise, I'm willing to bet on myself and do it.
And yet far fewer women are being promoted to manager for the 8th year in a row. You're seeing this. Rachel, can you explain this to me? Because I feel like we're getting a lot of conflicting information. You know, I've also heard that more women are being promoted in-house, or that you are actually seeing that as a potential path to success, perhaps a more accessible path to success than bringing in new women to leadership roles from the outside. Rachel.
Emily, you're right. 8th year in a row, that broken rung at that first critical step up to manager is still broken. For every 100 women who were promoted to manager last year, for every 100 men, only 87 women were, and 82 women of color. And here's why that matters. At the typical company, when you look at the manager level, 60% of managers are men and 40% of managers are women, which means literally there are fewer women to promote. So that's company's first pipeline problem. And now we're talking about their second pipeline problem, which is on top of that, women leaders are leaving. So our message to organizations this year is we've got to really double, triple down on holding on to our women leaders and our up and coming women leaders.
The report cites 1 in 4 C-suite leaders is a woman, and only 1 in 20 is a woman of color. Lorena, are startups doing at all any better of a job than corporate America at getting these numbers up?
I wish we could say yes. Emily, we see pretty consistent lackluster results across any size company in the United States. And so to give you a flavor of this, if you're a Black woman, if you're a Latina woman, if you're an Asian woman, as you try and climb up, you just face so many challenges. And one thing that's really important to note is women of color are extremely ambitious. In fact, Black and Asian women want to succeed and rise up to leadership roles the most out of all people in your organization. And yet they face these challenges. So just as an example, if you are a Black woman, you are more likely, 3 times more likely, in fact, to be questioned on your credibility. And you receive the least amount of support from your manager. And all of these things add up. And in a world where we have 1 in 20 women of color at the very top, and given all the emphasis that companies have talked about and are aware in terms of racial reckoning, you would think that we would be making more progress. And the fact of the matter is that we're not.
Ooh, let's talk about the silver linings. You talk about remote work. You mentioned remote work earlier, but given these numbers, Rachel, how is remote work really showing up for women in the workplace?
We know before the pandemic, all employees, and particularly women, really valued flexibility. We also know that companies, many of them are continuing some commitment to at least a level of flexibility. But when you look at remote and hybrid work, what's really interesting is it's not just about flexibility for women. They're actually having a better workplace experience when they're working from home. They're less likely to experience those microaggressions we often talk about. Getting mistaken for someone more junior, having someone take credit for your ideas. And those obviously have a huge impact on women. So it's just one stat. Women with disabilities are half as likely to experience microaggressions when they're working at home, at their kitchen table, than when they're working in the office. So certainly flexibility is not the end-all be-all answer, but it's important to women because it allows them to fit work into their lives, and it's also delivering a better work experience.
So let's talk about a plan of action. Lorena, how can companies and managers and leaders use this information to use this as an opportunity to get better?
Exactly. And so what this does is it points a spotlight on what's not working. And granted, there are a lot of things that are not working, but there are solutions out there. When we take a look at better companies that are making more progress year over year, there are a couple things they do. One, they actually hold themselves and managers accountable. They don't just have dashboards that say that they need to improve, but they actually hold leaders accountable for that in their business reviews, in their performance evaluations. Another thing that we see is that they empower managers. They give them the tools to do better because certainly the positive intent is there. And the last thing is that we see that they do better in practices. So they really go beyond the basics. It's one thing to have an anti-bias training once a year. It's another thing to say, I'm going to have an anti-bias observer, and I'm going to really bust that bias in the moments that matter, which are performance reviews and evaluations. It's a whole nother thing to invest in career development versus just networking on women. Those are just a couple of examples, Emily, but there are some really concrete things that companies can do, and I'm extremely optimistic that they can step forward and do these things.
So I have to ask you about, of course, the founder of Lean In, who started this movement, and that is Sheryl Sandberg, who, now just a few weeks ago, left after a very long tenure at Facebook. Rachel, what can you tell us about Sheryl's next act and how much more time she's now going to be spending with Lean In and focused on these issues that, as part of a movement that really she catalyzed?
Yeah, so first of all, I love that Sheryl got to a point in her career where she was ready to leave, because we all as women have a right to make choices about our career, as you know so well, Emily. And as she said publicly, she's always been incredibly involved with the foundation and the work we do and fighting to knock down the biases and barriers that get in women's way in the workplace. And she's going to continue to do that. And we are thrilled to have more Sheryl Sandberg with us every day and really speaking up on these issues that are so critically important.
So, Lorena, last question. There's a lot to be worried about. What can we be optimistic about?
We should be optimistic about young women. So I'm so glad you asked. So in the survey this year, we found, and a lot of people wonder, women under 30, Gen X, Gen Z, what's their feeling? And I have some good news on that. They are so ambitious. They want to be senior leaders, and that has increased over the last couple of years. And they have a very clear view on a workplace that works for them, and they're going to step up and live into that. And so when we think about the future of women at work, I look at young women and I say, look, that is our future. We have to invest in them, develop them, and bring them up into the senior ranks.
All right. McKinsey's Lorena Yee, leanin.org's co-founder and CEO Rachel Thomas. Thank you both, and thank you for the work that you do on this report every year. We appreciate it. All right, coming up, why one crypto venture capitalist is asking the public to look at crypto as a technology, not a token. That's next. This is Bloomberg.
blockchain is a technology which is real, deployed in many places. We deploy it with Onyx, which some of you were part of, and Link, which some of you are part of, and the JP Morgan coin, which is a stable coin backed by a US dollar deposit at JP Morgan. And there are a lot of these technologies going to work. They're going to replace ledgers. They're going to make things cheaper. I think banks will be big users of that. And yes, it may disintermediate certain part of banking. So be it. That we have that problem, like with technology, for the last 50 years. And so my issue has always been with what you guys call a cryptocurrency, which I call a crypto token that doesn't do anything.
JP Morgan CEO Jamie Dimon last week doubling down on his disdain for crypto tokens, but backing blockchain technology. Earlier, Michael Anderson, co-founder of the crypto venture capital firm Framework Ventures, reacted to what Dimon has had to say on Bloomberg Crypto. Take a listen.
I think, the part about blockchain being real, he's completely right. There are a number of different application categories that are built on blockchain today. Cryptocurrency and Bitcoin just happens to be one of them. NFTs happen to be another. We're starting to see the rapid innovation of what these concepts can bring about, not just from a cost savings perspective for existing businesses, but new types of economic transactions that can exist in a new ecosystem that can connect into the financial ecosystem. And you touched on it in the previous segment, but gaming happens to be one of those segments of the market that's just completely new, and a new business model for gaming will bring about a huge amount of economic activity.
He makes an interesting point about the coins, Michael, and I've always wondered myself. I mean, even if you see the beauty in the blockchain, aside from, faith from the group, what's the reason that these tokens should be worth a lot of money, considering the fact that you don't really need even a full token to get on the blockchain, and they're infinitely divisible?
Yeah, well, I think one of the hardest things that we did for ourselves as an industry is called this industry the cryptocurrency industry. What it should have been, maybe crypto commodities would have been a better moniker for some of these assets, but really it's just a new technology platform. There are reasons why tokens need to exist in these ecosystems to secure networks. One of the ways that the proof of stake ecosystem for Ethereum works is you're taking Ethereum tokens and putting them up as economic security to validate transactions and provide security in that network. There is a core reason for that. And Ethereum in particular has a number of the amount of transaction revenue that's going through it every single day is tantamount to something that's a massively scalable and profitable company if it were to be traded on the NASDAQ like a Salesforce or a Workday. So if we look at them from that perspective, there are assets in this ecosystem that are fundamentally valuable.
Or tell us about some of the businesses you're invested in that are doing actual work with the blockchain that has nothing to do with the value of the token. For example, smart contracts or recording events. I mean, what can the blockchain do that you're actually seeing work in your companies?
Yeah, well, one of the companies that we just announced a large Series A fundraise for was Stardust. Hannah Miller, hats off to her, broke that story earlier today. They just raised a new round of funding, which we continued on with our existing investment. What they do is they provide an ecosystem for traditional game developers to develop their games and integrate blockchain just with the ease of integration of an API and some tooling and some infrastructure. We liken it to being sort of the Coinbase for Web3 gaming, where it'll just be the ramps for hundreds of developers who are building in this ecosystem who want to integrate NFTs. And frankly, the integration of NFTs just represents a new business model for game developers. It's not, a speculative fervor as we've seen with NFT gaming so far. The tens of developers that are building on top of it are actually, building and succeeding today. And we're just going to continue to see that trend continue.
Framework Ventures co-founder Michael Anderson. Coming up, what's going on with Facebook? Anyone know? Because Mark Zuckerberg sure isn't talking about it. We're going to talk about why next. This is Bloomberg. Let's take a look at Facebook now, which some might have think has been abandoned, so to speak. by Mark Zuckerberg in favor of his new child, Meta. That's just one interpretation, including from our own Max Chafkin, who wrote this piece for Bloomberg Businessweek, focused on what Mark Zuckerberg is talking about now. And it's not Facebook.
It's the metaverse.
But is he really ignoring Facebook? I mean, this is a huge platform, and it's not just Facebook, it's Instagram, it's WhatsApp.
So Facebook and WhatsApp and Instagram, this is still the core of Meta's business. And to, in some extent, they're continuing to, make the trains run on time and try to generate revenue and profit. And to be clear, this part of the business generates huge amounts of profit. And if you just looked at that part of the business by itself, you'd say, wow, Mark Zuckerberg is doing a really good job. But then when you sort of look at it in the context of this pivot, which is towards the metaverse, which happened, a little less than a year ago, company changed its name, of course, away from Facebook to this new thing. And then when you look at just like the comparison of user numbers, right? Basically 3 billion people every single day are coming into Facebook's properties, including Instagram, WhatsApp, and so on. It looks like about 200,000 people are in Horizon Worlds, which is the flagship virtual world that Zuckerberg was touting last week at Connect. And that's the kind of product, that's a product that if this happened with some other product that Facebook was offering, they would kill it, instantaneously. This is the kind of thing Mark Zuckerberg, I don't think, gets up in the morning for, 200,000 uniques. But of course, the company has decided that this is the future, and they're pushing towards it. And I would argue pushing towards it, at great risk to the brand and maybe to society in general.
Facebook still has a lot of issues. Instagram has issues. We've got an election coming up. If he's not paying so much attention to these platforms, what hope does that give us that these problems are going to be fixed?
Right. Well, it's important to say, the company would argue that, yes, of course we're paying attention to these things. It's the core of our business. Nick Clegg has been elevated to this, more important role, overseeing, stuff that includes elections. That said, I think when you go back, say, 2 years ago and look at, what the company was talking about, what Mark Zuckerberg was talking about, they were very focused, not just on elections, but on the responsibility that Facebook owes to its users, to society. Zuckerberg was talking all the time about, COVID, vaccines, and right now we're talking about, getting as many office workers into the metaverse, which I don't think has anything to do with those, issues of societal responsibility, might in fact work against them, and also, I'm not sure anyone even really wants that. I mean, they're talking about, sending workers to the metaverse at a time when most CEOs are trying to get their CEOs back to the office, back in person. Mm-hmm. So it feels like they're working against a bunch of trends and maybe even working against their business.
So the question is this going to work? In hindsight, are we going to, is he going to be able to, look, I was right. I mean, is it similar to mobile when Facebook transitioned to mobile and not everybody, but it seemed like a big leap at the time. Is this the same or is this different?
It's certainly possible. And if that happens, I think, we will all, bow down before, Mark Zuckerberg's prognostication, because he'll have done this, amazing pivot 2 times. Now, a couple of things. One is that pivot to mobile, Sheryl Sandberg was, very involved. He had help that maybe he doesn't have today. And just because he executes one pivot correctly, I'm not sure you can sort of say, well, he's going to execute the next pivot correctly. And the sort of leaks and the news that we've seen coming out of Facebook is not super encouraging. Mm-hmm. I mean, this is, as we learned last week in reports from The Verge and the New York Times, Facebook is having trouble keeping its own employees, interested in its metaverse app, which kind of makes you wonder, how are they going to get other people who don't actually work for Mark Zuckerberg excited about this.
All right, well, check out Max's latest piece in Bloomberg Businessweek. Max Chafkin, always good to have you. Good to see you here in person. Thank you. And that does it for this edition of Bloomberg Technology. Coming up Wednesday, we're going to be talking with the co-CEO of Warby Parker, Neil Blumenthal, talking about the future of his business after stock has tumbled a bit since their IPO. And don't forget to check out our podcast wherever you get your podcasts. I'm Emily Chang in New York today. This is Bloomberg.